Hello and welcome to Premier Study in Investing. It's great to have you. Thanks for stopping by.
Hey, welcome back. I think you're going to love this video. We're going to be looking at the impact of fees at the total amount over the course of a retirement fund. And we're going to be hearing from Jack Bogle. Jack was interviewed on a PBS special called The Retirement Gamble. I've talked about it before. Check it out. It's on YouTube and you can find it for free. It's really great, but I wanted you to see this one clip because Jack breaks it down and really gives us some shocking numbers. I'm going to kind of flip back and forth between his video and we're going to look at some Excel numbers, which it's a little boring, but they're so powerful, it's not that boring, and we'll kind of break it down about what they're talking about. So check this out.
To understand this fee business, I went to talk to someone who has thought long and hard about it. Jack Bogle, the founder of Vanguard, a company that offers some of the lowest fee products on the market. He says that if you want to improve your retirement outcome, make sure to minimize Wall Street's take.
Costs are a crucial part of the equation. It doesn't take a genius to know that the bigger the profit of the management company, the smaller the profit that investors get. The money managers always want more, and that's natural enough in most businesses, but it's not right for this business.
Bogle gave me an example. Assume you're invested in a fund that is earning a gross annual return of 7%. They charge you a 2% annual fee. Over 50 years, the difference between your net of 5%, the red line, and what you would have made without fees, the green line, is staggering. Bogle says you've lost almost 2/3 of what you would have had.
Okay, hey, I want to jump over here and look at those numbers because it sounded a little bit odd, as we're going to hear from two different people in the rest of this interview, that like, how can 2% fees year over year stack up to, at the end of 50 years, be 60%, 63% loss? Like that doesn't sound right. Well, let's take a look. On the left side, we're going to do the zero fee scenario, and on the right side, I have the 2% fee. So try to put the fees in red since that kind of seems to be reasonable. So how many periods? 50 periods, they said. So we're doing 50 years. We're just going to do an arbitrary number that's saying you started with $100,000 and it's negative because it's money out. You're giving that money up in order to invest it. That's kind of payment. They didn't talk about any money going in. It was just a single contribution at the beginning, growing at either 7% or 5% for 50 years. The growth rate is 0.07 in decimal form, and this is going to give us a ballpark estimation, $2.9 million at the end of 50 years. On this other scenario over here, it's exactly the same, 50 periods, $100,000 to start, zero contribution per year, 5% instead of 7, so 7 minus 2 is 5%, and you come up with 1.14 million. Dollars lost in fees is 1.78 million. I mean, almost 1.8 million dollars. Could you imagine that? If you had kids, grandkids, you wanted to leave a legacy, you wanted to donate to your college, you wanted to like set up a foundation for your favorite charity, you just lost 1.8 million dollars. It's nuts. In this situation, it works out to be 61%. Now, if I convert that to monthly compounding, we'll get to our 63%. I'll do that here. So in order to do that, the first thing we need to do is take the 50 times 12 because we know there's 12 months in every year, and so that'll give us 600 periods. But we're not going to have a monthly rate of 7%. Our rate is going to be 7% divided by 12. We're going to break it up like that. And if we work this out, we end up losing over $2 million of our possible 3.2 that we could have earned, equaling a 63.03% loss. That's the amount of money lost to fees. I mean, that's just how it works. If you want to do this work yourself, you're basically just going to be using the FV. It's the future value formula in Excel. And if you just press =FV, it'll basically give you prompts for what you want to put in for each of the corresponding cells. So it's very user-friendly. 63% loss. Let's go back to the video.
What happens in the fund business is the magic of compound returns is overwhelmed by the tyranny of compounding costs. It's a mathematical fact. There's no getting around it. The fact that we don't look at it, too bad for us.
What I have a hard time understanding is that 2% fee that I might pay to an actively managed mutual fund is going to really have a great impact on my future retirement savings.
Well, you have to rely on somebody to get out a compound interest table and look at the impact over an investment lifetime. Do you really want to invest in a system where you put up 100% of the capital, you the mutual fund shareholder. You take 100% of the risk, and you get 30% of the return.
I wanted to know how others would react to Bogle's claims. J.P. Morgan Chase offers more than 100 mutual funds that charge anywhere from less than half of 1% to more than 2.5% annually. So I took Bogle's advice, found a compounding calculator online, and used a simple example in order to isolate the effect of fees. Take an account with a $100,000 balance and reduce it by 2% a year. At the end of 50 years, that 2% annual charge would subtract $63,000 from your account, a loss of 63%, leaving you with just a little over $36,000.
So let's take a look at what that correspondent was doing. He basically went online, found a compounding calculator, and if you noticed, he did $100,000, 50 years, but the compounding period was by month. And so what we're going to do here is we're going to have the 600 periods. That's 50 times 12. You can see the negative $100,000. They're not considering any payments during the course or over those 50 years. And so what we just need to do is change this 0.07, the positive 7% divided by 12. So the 7% basically monthly return. We need to change it to 2, and we need to make it negative because it's like a loss is what they're doing. And if you do that, you get the 36,757. So again, you're still just using the FV, it's the future value function that comes standard in Excel. So you can see you started with 100,000 at the end of losing, 2% basically a year over 50 years. He ends up with $36,757, which is exactly what you'll see on the screen here.
Your account, a loss of 63%, leaving you with just a little over $36,000.
Okay, I'm excited. I want to drive this point home a little bit more because I use this image on our landing page for our portfolio creation course. And when I first saw it, I said, this cannot be right. Well, what this is 6 different pie charts, as you can see. And the red sections denote the amount of money that you're going to be losing to fees. So you can see some of these, well, it gets pretty big. And then by the time you get to this 2% fee category, it's a large amount of money that you're losing to the red. You may think, okay, yeah, that is a big section, but weren't they just saying in that previous section of the video that people would lose something like 63%? We just calculated that, right? 63%. So it's like, this is only maybe a third, not like 2/3 red. Shouldn't all this be red? A lot more of it. And the reason is the math changes if you get into a little more real world scenario where you're kicking in a little bit of money each year, okay? So the assumptions for this graph is that initially at time 0, day 1, whatever you want to call it, there's $6,000 that's in the account. And then each year there's an additional $6,000 that, say, I kick in. How long am I going to do this? I'm going to do it for 30 years, and we're assuming that I'm going to get an annual rate of return of 8%. At the end of 30 years, that account will grow to $794,451. So let's go up and make sure that we can get those numbers and see how they're coming up with that in this. So here's our match, 794,451, and what they're doing is they're using annualized figures. So how many years are in a 30-year period? There's just 30. Present value is 6,000. Payments per year, 6,000 additional, and then the rate of return was 8%. If you use the FV formula with the compounding starting at the beginning of the period, so you're going to do comma 1, you'll get exactly that number, 794,451. And so that's what you would get if you did that scenario, assuming no fees. Now you can see on this section I added all the fees. They have 0.04% fees, 0.015 is here, 0.5%, 1%, 1.5%, and then 2. So I converted those percentages to decimal here in the red. And so like this one is really easy to see, 0.02, that's equivalent to 2%. 0.015, obviously can. So you see what's going on here. The periods don't change across here. The starting present values don't change. The amount contributed doesn't change. But the rates will change, right? So this is just going to be the 8% that we start in our base case minus whatever's here in this section for our fees. And so you'll see the dollars lost depending upon which level of fee you're paying. So here we see you're losing $6,302, which is the match to what they have. Here you're losing $23,353, $74,995 is here. So it works out to be 9.4% of your total take is lost to fees. As you move up into that 1, 1.5, and 2%, you're losing 18% almost, 25%, or 32%. So it's really it's nuts. It's a wild amount in percentages. It's also a wild amount of money. I mean, this is, I argue on the website, this is $257,000. There's a lot of places in the world that you can buy a house or at least a small condo, right? And you're giving that to a mutual fund, to a JP Morgan Chase, just because you can't simply go online, spend a few hours opening a brokerage account and figuring it out. Like, even if you don't use the method that I've been working with, using modern portfolio theory, there's a lot of different strategies, momentum investing. There's all kinds of ways to go about learning how to do this, but I just want to give a big encouragement. Look at how much is lost. This is $250,000, you guys. And I mean, that is money, like I argued in the beginning, you may want to give to your kids, grandkids. You could buy, a house. It's just all kinds of crazy things. If this rate is better than 8%, which 8% is fairly conservative, I suppose. I'm not sure exactly what the 10-year average return rate is on the S&P 500, or say, like, maybe the easier way to say it is just the average annual return rate on the S&P 500. I think it's better than 8%. I think it's somewhere between 10 and 12%. So it's a crazy amount of money. I mean, if you want to change any of these scenarios, and if you want to change like the base case to a 12%, I mean, numbers go way up in your favor. You could make as much as 1.8 million, but you're giving up $600,000 to fees on the 2% scenario. So, I mean, I don't know how else to stress it, but I just felt like, man, those numbers might sound crazy, but check out the rest of this video. You know, some of the guys also struggled to believe that those were realistic numbers. But you can go in here, you can use the super future value formula in Excel really easily. You can do the math on your own if you don't believe me, or if you need a reminder. It's the future value. It's equal FV, follow the prompts. You just need 4 pieces of information. You just need the number of periods, you need the present value, you need the payment per period, and the return per period. If you want to switch from a monthly compounding to an annual compounding back and forth, it's just you're going to need to change the number of periods. The payment needs to be on a monthly basis, and the rate needs to be the annual rate divided by 12 if you're running monthly. And the numbers are slightly different, but basically the compounding isn't the huge part of it. The huge part of it is all that money you're losing to fees. So I've talked a lot, but man, is it not amazing? I mean, is it not super motivating to say, you know what, I'm going to figure this investing thing out, even if I just start with some bond ETFs and some index funds or some utility companies or something, and just kind of go easy in the beginning, not a lot of money, maybe just be real conservative, keep it real safe in something like BIL, which is a short-term U.S. Treasury bond fund, or just something like that, until you really get a better feel of what's going on. I think it's the right way to go. Honestly, I do. So if I didn't think so, I wouldn't be making this. Anyways, thank you so much for joining me. Check out the whole thing. It's called The Retirement Gamble. It's put out by PBS, and it's free on YouTube. Thanks so much for joining me on Premier Study and Investing. Join us on our website, www.premierstudyandinvesting.com. We have a course. We have a Patreon site. We do videos. I'm getting excited. Thanks so much. Bye.